The three numbers that decide whether you keep what you earn. Now, maybe you're booked out 3 weeks deep, but you're still broke at the end of the month. Maybe you're the dearest rate in town, turns out you're still broke. Or maybe your invoice book looks really, really fat, the diary is always full, and your bays look completely jammed, but your bank account tells us another story. Now, if that's your shop, I need you to hear this next part. Most owners look at a busy shop and they think it's a healthy shop because flat out means winning, right? So they chase more jobs, more cars, more hours. They just want to do more and more and more. But the problem is they keep doing more, but they keep staying broke because busier and broker can happen at the same time. So here's what's actually going on. It's not a revenue problem. You've got plenty of revenue. It's a gross profit problem. You're measuring the wrong number. Turnover is what comes in through the door, but gross profit is what actually stays. And almost nobody in this industry ever measured the three numbers that decide how much of that turnover they get to keep. So they price on gut feel. They send the invoice and they find out at the end of the year, usually through their accountant, that the busiest year of their life made them next to nothing. Sound familiar? Once you've seen these three numbers, you can't unsee them. Now, in a minute, I'm going to give you these three numbers and a simple picture that shows you exactly where your money leaks out before it ever reaches your bank account. But before we get into it, we've got a free markup, margins, and matrix cheat sheet. It clears up the one bit of confusion that quietly keeps most shop owners under benchmark, so it connects straight to what we're covering today. The link is in the description box below. You can go and grab it at the end of today's episode. Let me show you this first number. Now, this big box, this big green box, this is your revenue, right? It's your turnover, it's your total sales, it's your total income. It's the number you probably tell people your business is earning at the barbecue because it's the number that feels the closest to something like success. It's probably the number you've been chasing your whole career. Bigger revenue, bigger income, bigger sales. But watch what happens when I talk about what you actually keep. And that's your gross profit. This little box is your gross profit, right? Gross profit is what's left after the costs of your parts, cost of any consumables, cost of any products came out of your revenue. And it's this little box, not the big one. It's the little box that pays you. The gross profit is the money that runs your shop. It's the money that pays your tax. It's the money that puts food on your family's table. Now, here's the benchmark. You can see I've written it in here for you, right? Across all your invoices, on average, the gross profit box should be sitting between 58 and 62% of your total revenue. That's 58 to 62%. That's the number for a healthy, solidly profitable, independent auto repair shop. If you can hit that consistently, then there's enough room left over to run the business properly and pay yourself what you're worth. But if you miss it, then you will work flat out every single day for a number that never shows up in your bank account. And this is the trap because most owners spend their entire career staring at this big box, revenue box. You know, if their turnover is up, then they think it's a good year. If the turnover is down, they think it's a bad year. But they never, or if ever, rarely look at the small box. So they never find out that the busiest month of the year was also one of their least profitable. And here's the kicker. You don't get paid on the big box of revenue. you get paid on the little box of gross profit. Let me draw this to you or for you in another way. So we know gross profit here, 58 to 62%, right? But let me show you what that number is actually made of, because your gross profit figure is fed by two other numbers, and they work exactly like a pinball table, right? Money comes into your shop, right? Every job, every invoice, every customer pays you dollars that funnel into your shop, right? But on the way down, the money on your invoices that is paid to you by your customers for the jobs that you complete has to get past two paddles. The left is your labor GP, the right is your parts GP, right? Your labor gross profit has to be sitting somewhere between 70 to 74%. For your parts GP, the benchmark there is 48 to 52%. Now, when both paddles are up where they should be, then that money finds its way through into the gross profit box, right? Those paddles, they trap the money and they drop it into that bucket, gross profit, right? And we know that's 58 to 62%. And that bucket, the gross profit bucket, well, that has to fund four things. First off, has to fund your operating expenses, the bills that you have to pay for your business, the utilities that you need to pay for your location, and your team costs, the wages, super, annual leave, sick leave, right? Not to mention your parts. That's your OPEX. Secondly, that gross profit box has to fund your tax, your company tax, your personal income tax, GST. Although ideally we take that out before the money hits the gross profit box, right? But personal income tax, company tax. The gross profit box has to fund your owner's pay, whether you pay yourself as a wage, as a salary, if you take drawings or dividends, profit share. Gross profit box has to fund your owner's pay. And whatever's left over is profit. We do teach a model called profit first. You can probably work out what it means. It means we actually put your profit away first, then we distribute money via your owner's pay, tax, and operating expenses. But ultimately, what's left in that gross profit box has to pay for the running of the business, pay the tax office, put some money in your back pocket to fund your life and your family's life. And if you run the leanest, healthiest, strongest financial operation, then you're going to have profit left over, right? But here's what happens in most shops, right? These paddles don't stay up. They actually drop. And what that means is that instead of money funneling through here the way that we want, well, money actually trickles out the side, right? So maybe your labor rate's too low, right? Maybe we know the benchmark is between 135 to 155, but maybe your labor rate is lower than that. So the paddle's done, money leaks out the side, right? Maybe on the part side, you're pricing off the recommended retail price. So your parts GP is too low. So the money that you're working really hard to bring in is actually draining out of the gutter, right? It's not finding its way in here. And so you only have this amount left in your GP, you don't get the full amount in your GP. So the bucket comes up short, and that means there's not enough to pay the tax office. There's not enough to pay you properly. The ends don't quite meet in your operating expenses, and your profit account, your profit bucket, that gets scraps if it gets anything at all. So when your overall number, labour GP, parts GP, are not where they need to be, then your gross profit, you won't hit your gross profit mark, right? So if gross profit's down, there's only ever two places to go looking: labour GP, parts GP. And here's where I need to be absolutely straight with you. Knowing the targets is the easy part, right? I've just given them to you: 70 to 74% for labour, 48 to 52% for parts, leaving gross profit percentage as 58 to 62%, right? But it's knowing what to do when you're 12 percentage points under, or 8 percentage points under, or 4 percentage points under. Well, that's actually the work. And there's a diagnostic that we can run to find out which one of the paddles, labour or parts GP, is actually dragging you down, right? We can do a labour rate diagnostic. We can do a parts matrix diagnostic. And there's an order that you move them in, because if you get the order wrong, you can actually make things worse before they begin to get better. Now, I'm not going to run that whole sequence with you here on this call or on this whiteboard, because that's the work that we do with our members inside the engine room or our $1 Million Mechanic boardroom clients. But I can absolutely show you where you stand right now. And that's where we're headed next, right? So now you've got the three numbers and this pinball table analogy, right? Paddles, if they're up and in, they funnel the money into your gross profit. Flat, money trickles out. You're losing the game, right? Getting those paddles up starts with the one thing that most auto repair shop owners get wrong, and that is that they mix up markups and margins when they're pricing out their parts and their products on their invoices. And the most common error is that they price parts off the suppliers list, off the suppliers list, the recommended retail price, or as we like to call, the random retail price, instead of off a target, right? Because the recommended retail price was made up by someone in office that has no idea about your operating expenses. They have no idea about what you want to pay yourself. They have no idea about what the profit benchmark is for a solidly profitable auto repair shop. It is a random retail price, random recommended price, right? So we need to move away from that. And that's why we made you a free markup, margins, and matrix cheat sheet. It shows you the difference in plain English, and it gives you a parts matrix that is built to help you hit the gross profit percentage benchmark. Not one that you Googled, not one that your mate down the road told you, an actual pricing structure and strategy that helps you to hit your gross profit mark. You can pause the video now, open up the description box, click on the link, grab that cheat sheet, then come back and finish this with me, right? So here's the anchor. You don't get paid on what you turn over in revenue, right? You get paid from what you keep. Just sit that with a second. Sit with that for a second. You don't get paid on what you make. You get paid on what you keep. Right? Now, three questions. This is how you run these numbers for yourself this week, right? On your own shop. Now, across the last month, what has been your overall gross profit percentage? And is it sitting between 58 and 62%? Don't take a guess. Pull your P&L out, pull your figures out, and work it out. Most owners have genuinely never done this, and the first time they do, it stings. And when they start to understand what they're working towards, well, then the GP percentage changes everything. Now, second, let's split that figure, the gross profit figure, in two. And let's look at what's your labour gross profit. Okay? Labour should be between 70 to 74%. What about your parts? Look at your parts over the last month. What's the average been? It should be sitting between 48 to 52%. Look at your figures, calculate those two percentages, and write down the actual figures for your workshop next to those two benchmarks. And the third question, well, which of those two paddles, labour GP or parts GP, is actually dragging your gross profit number down? Is it labour? Is it parts? Potentially it's both. Now you don't need to fix it today, but you do want to start to understand and know where the money is leaking out. That means you're missing the gross profit percentage of 58 to 62%. Because the owner who says, I think we're doing all right, well, they're stuck. They are working harder and harder and harder, chasing revenue, believing that that's going to solve the problem. Right? But the auto repair owner who is free, who's got the profit and the time to show for it, well, they actually say, look, yeah, our labour's fine, but our parts are 8%. Our parts GP is 8% below benchmark. For this month, that's where the money's leaking out. And this is exactly the type of benchmarking and calculations that we install and work with inside the engine room. We take owners who've been flying blind on these three key numbers, and we get every one of them to the benchmark for a solidly profitable independent auto repair shop. And we do it in the right order and at the right time with a system behind it. So here's the shift, right? Turnover is what you brag about. It's the big number that makes you feel good and sounds fancy to your friends around the barbecue, right? But gross profit, that's what you bank. A full diary, a flat-out team, and chaos doesn't pay you. Healthy margins pay you. Healthy labour rates pay you. And in most cases, you don't have a revenue problem, you've got a gross profit problem. And now you know the three numbers that prove it, right? So if this episode has you thinking differently about your business and you want to see, finally, how we help auto repair shop owners keep more of what they already earn, you can learn more just by clicking the links in the description box below. There's no pressure to do anything. You won't suddenly receive a random phone call from a random stranger trying to sell you something. All you'll get is clear information to help you decide if now is the right time and we might be the right fit to give you some help with your auto repair shop. And I'll see you on the next episode of the A-Grade Auto Repair Shop Show.